Okay, welcome back. We've got the market, which is up 30 points. I mean, 20, 30 points coming and going just like that without very much, happening at all. This is quite amazing. But we've had markets like that before. I think yesterday was no different, although it was more secular in terms of the fall that we saw. Starting about 11:30, markets continue to slip. Today, so far, it's much more flattish. Okay, we've got the management of Sterlite Technologies, which is the next corporate on our radar. The company's reported a mixed set of earnings for the third quarter. The services business looks weak. It's down about 7.5% versus the last quarter. But the optical business saw healthy growth both sequentially and on a year-on-year basis. Ankit Agarwal is Managing Director at Sterlite Technologies. He's joining us now to take some questions and talk about how things are looking now. Ankit, great to have you with us here. Thanks very much for your time. Prashant this side. Could you, let's start with the services business, Ankit, if we could. About 7.5% slip on a quarter-on-quarter basis, about 22.5% on a year-on-year basis, EBITDA of about 1%, again, flat sequentially. Could you talk to us about, how that business, what happened in that business, how is it looking this quarter so far, and what's the outlook?
Sure. Thanks, Prashant. So I think first is, definitely overall from HTL perspective, we're very focused on core being the optical business. And as we shared earlier, we're very consciously looking at what projects we take up on services from two areas. One is we want to reduce our exposure from government and focus more on the private sector. And that's something that you will starting to see in our order book and our revenues going forward. The second thing is that we have a UK business where we do services deployment in the UK as well, which is currently loss-making. So that is where we are closely evaluating how do we turn that around over the next, say, 4 to 5 months. And on top of that, in India as well, we're consciously looking at how to take up projects with our better margins. So overall for this business, the priority is to improve the EBITDA towards, say, 7 to 8% in the near term. And then the second part is to ensure that the cash cycle, which currently is north of 300 days, to bring that down substantially. So these are the two focus areas.
So you're saying that you want to reduce your exposure from the government sector. Is it because of delays in payments, deferral of orders? Why is it that you want to change your, proportion between government and private? And what do you see as the growth for the services space?
Yeah, absolutely. So I think it's more in line with where we see the opportunities. I think when we look at, tier one operators that we work with like Jio, Airtel, they are looking at really investing significantly on the digital infrastructure, especially linked to 5G as well as fiber to the home. Plus, with areas that people will be exploring in terms of private enterprise, etc., data centers. So I think there's enough and more opportunities for us to explore there. Certainly, there are certain projects like BharatNet, etc., which are interesting, and we'll evaluate those as those opportunities come up. But our prime go-to-market globally continues to be the optical side of business. And overall on services, we'll be very selective in which areas we participate.
Okay, all right. Ankit, I think you're guiding for around mid-20s growth, right? 23 to 25%. Could you tell us, break it up between optical fiber as well as services, point number one. And also margins are expected to improve from these 13.5% odd. To what levels should we look at in FY24?
Sure. So just to be clear, what we are specifically guiding right now is our EBITDA percentage on the optical business. Currently, it's at about 20%, and that we are confident we'll be able to sustain through next year. So I think that's our core business. We also have volume improvement coming in through our operations in US, which is our cable operations, which are coming up, as well as growth in Italy and India. In addition to that, we have optic fiber manufacturing in China, which will restart. So these are the volume drivers that will come into next year. And one of the cost areas that we currently see is quite high is helium, which is having a significant impact on our costs on the fiber side. That we hopefully start seeing a reduction with global helium prices coming down probably in 6 to 8 months from now. So overall, what we are looking at is from the current 13% EBITDA to start moving towards 15% or EBITDA at HTL level. And at a top line perspective, at least from the optical part, we're certainly looking at growth of 15% plus for next year.
Okay, so 15% growth for next year, and you see a lot of opportunities in the private sector. You spoke about how Jio, Airtel are investing in 5G and fiber to home. So that's, of course, helping you with your business. Will this in any way help you with your balance sheet as well, trying to understand whether there is any scope to bring down your debt? I mean, you're sitting on debt of around, I think, a little over 5,200 crores. Any success in bringing it down?
Yeah, absolutely. So I think that's a critical driver for us is overall looking at generating cash from the business and then reducing the debt. Two, three elements to this. One is broadly this year we will be doing about 500 crores of capex, and next year it will be closer to about 350 or 400 crores. So one is just ensuring that our peak investment cycle is done and we start reducing the capex investment. The second part is certainly with the growth of optical and looking at areas like optical interconnect to further improve our margins. We do believe that we'll be generating cash. As you would have seen in Q3 itself, we were now at about 250 crore EBITDA run rate, which takes us to a 1,000 crore run rate basis. So we are confident that when we look at our overall cash generation from the business, particularly from the optical business, that we can use the cash to reduce the debt. On top of that, we have also taken a rights issue plan for 500 crores. So as that also comes through, that will further help us reduce the debt.
You want to give us a number? How much do you think your debt could go down by? What are you targeting, say, 12 to 18 months down the line?
Yeah, so currently what we see is that from about 3.6, 3.7 times net debt to EBITDA, we want to take this down to about 2.5, 2.6 times in broadly about 15 months. So that's something that we're focused on internally. And again, as we're just finalizing our business plans for next year, we're clearly looking at how do we generate the cash and reduce the debt.
All right, Ankit, what about the rights issue? I think you've taken approval for 500 crores of rights issue, right? When does it take place? First half or second half of the year?
So we've not, I think we have a committee that we have in place. Broadly, what we have shared is that the quantum is 500 crores. And that the promoters will be participating. When we have a committee, which will share the details in due course.
Okay, and your debt currently is around 3,400 crores, right? Net debt?
That's right.
So keeping in mind the capex, the internal accruals that you'll be doing, plus this rights issue, you'll end FY24 with a net debt of?
So currently we're looking at around 3,200, 3,300 crore of net debt. And then obviously, as I said, cash generation next year, the rights issue, as well as lower capex next year, there we believe that we should start seeing further reduction in our net debt.
You have been gaining market share in certain geographies in the quarter gone by, at least in the first half of FY23. Can you tell us what's the market share currently like? Are you still gaining ground? And across geographies, if you can give us a sense?
Yeah, absolutely. It's something that we're very excited by. We're very passionate about taking the Indian technology, Indian manufacturing products to the world. We're very proud that now we have north of 14%, 15% share of US, north of 20% market share of Europe, and really leading positions in markets like UK, Italy, etc. So that's something that we continue to see strong growth. Just to give you a sense of a couple of markets, like US, we believe that for the next 3 to 4 years, there will be a CAGR between now and 2025 of almost 12 to 14%. And again, in Europe, also between 7 to 8%. So fairly strong growth markets for us. Between just these two markets is about 75-80% of our optical sales. So quite focused on manufacturing globally with a core base in India, and then selling to tier 1 telecom operators around the world. That's something that we continue to see quite positive momentum going forward.
All right, Ankit, we'll leave it there. Good luck. Thank you very much for joining us, as always, to talk about the business picture overall. Thanks indeed. That's Sterlite Tech in focus. 13 points, so absolutely flat kind of session so far. But stocks are moving around, and we'll kind of put the spotlight on some of that stuff in just a bit from now. We'll take a break, and we will come back with... Okay. We have, I think, Mitesh Thakkar joining us now, so we won't take that break a little later to analyze the markets from a technical perspective. This is, of course, charting trends. Mitesh, welcome back. Good morning. Good to have you with us here. Largely range, right? So with little indication of either a breakout or a breakdown, what's your sense? I mean, is the probability sort of more skewed in either direction to your mind? Or we'll just let prices tell us?
So, Prashant, I think, starting from last week of December, we've broadly been doing 18,200 and 17,500. That was just before the budget when that fall happened. But otherwise, we've not had a directional leg, which is showing a big bias on any side. So my sense is that I think, the index, if you were to even look at the monthly charts and the weekly charts, most of the volatility indicators which were expanding when the market was making new highs around 18,600, 18,700 levels, I think they've started turning flat, and I think it clearly shows that next couple of months or next at least one and a half, 2 quarters would be spent in consolidation kind of a thing. So you can, I was looking at the long-term chart support towards, and I think around 17,000, 17,050 is the long-term support area. And I think on the upside, this recent highs of 18,650, which was the weekly closing high, I think that becomes the counters, and I don't expect the market to do anything more than this range in the next 2 quarters or so, which is about 6 months from here.
Okay, I wanted your thoughts on some charts which are looking very good. Siemens, for example, has hit a fresh 52-week high this morning. It's up 2.5%, and now Siemens has rallied, 16% this year already. Mitesh, more upsides here?
Very likely. I think the stock is clearly in a medium to long-term uptrend. And, the last breakout happened sometime in first, second week of February when the stock started getting past the earlier highs of 3,100. And that momentum is clearly showing that there is many more higher highs and higher lows pending in the stock. I would very comfortably pencil in a target in excess of 3,600, 3,650 here. Though I think, if you were to extend the overall setup and look at, not retracement but extension targets, then I think the targets come around 3,900. So 3,900 is what I think the stock can do with if there's no negative news coming in the between, and that could take about 2 to 3 months from here.
All right, and any other stock ideas that you have for the hour or for the day?
So, given the fact that the index looks very ranged and the very similar outlook is what I can make on the Bank Nifty on the longer term charts, I was basically comping the mid cap space or the small cap space for trading ideas, and looking at stocks where some kind of medium to long term uptrend signals are there. And I've identified a couple of software names. So Tata Software, I think, completed a good rounding formation. It made a high of around 680 in August, September last year, and then corrected to about 460 odd levels, and then again has given a breakout about that 680 level last week. Now, the entire rounding formation gives you a target in excess of around 950 to about 990 odd levels, and I think keeping that as a target, I think the stock becomes accumulated at current levels. If you get a mild pullback to that 680, which was the breakout level, add more. And I suspect now it will be very difficult for the stock to break below 640, 630 levels, which were the earlier weekly pivots. So therefore, below 630 becomes your stop loss. So if you can, basically accumulate with an average price of around 700, you have a 10% kind of risk with a 35, 40% kind of an upside, which the stock can do in the next 3 to 4 to 5 months. Coming on to the next idea, which I have again.
Sorry, yeah.
That's right. Cyient is another one. I think the numbers this quarter were excellent, and that kind of started a medium to longer term uptrend, Prashant. The earlier monthly closing was around 1,050, 1,100. So that becomes a pivot. But I suspect once it breaks that, and I think the momentum indicators are suggesting that there will be a good and a very strong chance of a breakout, I think then the entire rounding formation will give you a target in excess of 1,350, 1,400 plus levels. So that's a buy accumulate as well. And I think any mild declines to about levels of 900, 920 would also be welcome buying opportunity or adding opportunity to your existing positions. And I think on the downside, I suspect 850, which was the monthly pivot made in the month of July, August of 2022, will not be broken. So that gives you roughly about 10% kind of a risk with about 35, 40% kind of an upside.
All right, Mitesh, and what about Linde India? That's been the big stock in the last few years. I've seen it move very swiftly. I think in COVID period it was around 500-600 rupees. From there it re-rated and it's holding on to those gains as well. What's the view out there?
I think, of course, that rally post the COVID period was excellent. But even in the recent few weeks, Nigel, the stock had, made what I would call as a good triangular pattern. It made a high of around 3,900, then went down to about 2,900, and then we saw a series of lower highs and lower lows. Basically, the entire movement was contracting within within two lines, which looks like a triangle, and it's broken out of that triangle last week. So this breakout, which was about 1,000, 1,100 point kind of a triangle, The breakout happened at about 3,400 odd level. So it gives you roughly about a target of, 4,500 to about 4,600. And if you add extension to it, with a strong possibility of stock heading towards 5,000. So that remains a buy. I think again, the stock on the downside will not now break below the 3,400 level. So you would want to buy it now a bit in parts. And then in case you get a pullback or a mild decline, add more, keep a stop below 3,400. And I would suggest a target of 4,500 to begin with. But logically, 5,000 is what I'm looking at.
GMM Pfaudler has corrected a little bit, Mitesh. What are your thoughts there?
Prashant, that's been a stock which is an excellent in the last few years. I think, a lot of fund managers have recommended the stock. But if you were to look at the longer term charts, it made a high of around 2,000 in the year of 2020. And then, corrected to levels of around 1,250 from there. And then post that, I think on multiple occasions, and if you look at the monthly chart, you can possibly see 5 or 6 candlesticks, when the level of 2,000 was tested, but a closing never happened above that. And now we are getting signs of a breakdown, which means that 2,000 becomes a very strong high for the stock. I think as a minimum, I would expect the stock to head towards 1,250, which was the low post the first high. If that gets broken, then we'll look at lower levels. But for the timing, if somebody has been holding GMM Pfaudler in their portfolio, good time to take profits over here.
Okay, all right. Thanks a lot, Mitesh, for that. We'll slip into a quick break on that note. On the other side of the break, Manisha Gupta will join in for a quick word on what's been happening in the world of commodities. Stay with us. All right, let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is here. Manisha, anything interesting there? Because the equity markets are so, slow this morning.
Well, I wish I could help you there. But, I'm looking at metals really, Sonia, and we have two worlds here. One, the non-ferrous metals, which have continued to decline. The last week was bad. Yesterday, we did see some buying, but today, yet again, there is profit taking there. But it is the ferrous metals, steel and iron ore, that is, and that has continued to inch up on the higher side. So whether you look at on a week-on-week basis or a month-on-month basis, we are trading in the positive here. The street is keeping a keen eye on China's National People's Congress that may announce further stimulus measures in the month of March. So that sentiment buying has continued in case of the ferrous metals there. Also, the economic data has come in on the stronger side. So China new home sales have grown for the third straight week in the 16 major cities that the index watches out for. That is a positive for the construction side as well. So when you look at the steel prices, we are trading very close to those 7-month highs in the Chinese and the international markets there. Also, the data from China shows that whether it is about the China electric arc or the blast furnaces, there is increase in production in the steel mills and the downstream companies as well. Same is the case with the iron ore prices. We have seen iron ore prices gain up by 30% from its October lows. There is onshore, offshore, both ways you are looking at lower inventories, and that has been supportive. Onshore inventories itself are down 30% year on year, and they are the lowest since 2016 as of now. There's an interesting report from Goldman Sachs which says that they are very bullish on iron ore and they expect a big deficit in the second quarter, and that is when they're estimating $150 per ton to come back. By the time the third quarter and the fourth quarter come, they have continued to downgrade their forecast in sense of iron ore prices. Goldman Sachs also goes on to say that by 2024, you could be looking at iron ore prices below $100 a barrel as well, a ton as well. So there is near-term tightness that we are seeing. That is a view also coming in from Macquarie, which says that they also are looking at lower inventories, increase in demand, especially coming in from China and rest of Asia. Even the Europe demand seems to be picking up right now. So there is some support that you can continue to see in sense of steel and iron ore going forward.
Okay, all right, Manisha, thanks a lot for that. Well, let's get to top stocks that we're tracking at around 10 a.m. Uflex, that's the stock in focus. We had some flashes that were running for you on the ticker. This after reports of IT department conducting searches at its Noida office. Timsy joins us to fill us in with more details on that. Timsy?
Well, as we speak, the searches have just started sometime back at Noida office of Uflex. What government sources are indicating to us is that the income tax department began this search operation in the morning after having done a thorough internal investigation, especially about allegations that Uflex has concealed income via issuance of bogus bills, etc. And that is something that they are right now looking for evidences for. Let's see how long this search operation continues at the Noida office and whether they actually plan to expand it further or not. But yes, right now only this much information, and yes, not to forget that the searches are underway. As day progresses, we'll keep you updated.
Okay, thanks a lot for that. So that's on UFlex, down 2.5%. And in a rising market, another stock that's under pressure is Minda Corp. It's down 2.5% right now. As we were telling you earlier, Minda Corp had an analyst meet yesterday where they said that the 15.7% stake buy in pre-call is only a financial investment and nothing more. They will continue to be just a minority shareholder with no special rights in the company, and they will continue to explore all opportunities going ahead. Now, why is the stock under pressure? A lot of brokerages have been a bit cautious on the stock post this stake buy. The fact that it is a mere financial transaction and nothing more is something that is a bit of a disappointment. In fact, Nirmal Bang put out a note where they are concerned about the company's capital allocation strategy. They say that by investing that money in just a financial stake, they have foregone the interest income. It is an EPS dilutive deal as well. The return ratios could be compromised because of this, and they are concerned about the capital allocation. So these are a couple of concerns that have been highlighted. The stock is now down to the lowest point of trade, down almost 2.5%. In fact, let's listen in to what the Minda Corp management told analysts in the call yesterday.
Minda Corporation has purchased 15.7% equity in Precall for a cumulative amount of 400 crores through on-market transactions on 17 February 2023. The shares of Precall are purchased solely for the investment of the surplus funds available with the company. Minda Corporation investment in Precall is through market purchases constituting a minority stake, and this investment does not grant any special rights. Minda Corporation is and will be generating enough free cash flow from operations to fund our routine capex and organic growth. The company has well-positioned balance sheet. We have, after this investment, we'll have a debt to equity at about 0.3, and the debt to EBITDA will be around 1:1. The long-term debt as of today is about 150 crores. Short-term is to the tune of about 350.
Okay, as we were discussing earlier, the Minda market's not taking very kindly to the commentary that the Minda Corporation management did lay out in the conference call. 3% lower on the stock. Now, the power sector is in focus. We've been kind of highlighting that. Stocks, in some cases, are doing well. Vivek is here with a spotlight on that space once again. Vivek, hi, morning.
Well, good morning. Like we highlighted earlier during the day, what the Power Ministry has done is they've gone ahead and preempted the kind of expected rise that they're seeing as far as the power electricity demand is concerned, especially in the peak load season that we see during the summer season. So now what they've done is, in anticipation of that, they've gone ahead and invoked Section 11 of the Electricity Act, and this is mainly to meet the expected rise as far as power demand is concerned. In fact, the Power Ministry is actually expecting a peak electricity demand of 229 gigawatts as far as April 2023 is concerned, and to go ahead and offset any likely shortages that thermal power plants may see in terms of coal, what they've done is they've accepted that all imported coal-based power plants can now operate and generate power at full capacity with a cost pass-through. That actually was the key point of concern between most of the stakeholders. So which are the stocks that are impacted? While the entire power sector will actually benefit on the back of expected higher availability and higher prices, two stocks specifically that we can look at are Tata Power as well as Adani Power, on the back of the fact that the Mundra coal power plant actually depends on coal from Indonesian mines. So on the back of this anticipated cost pass-through that will be allowed, you're actually seeing some positive uptick as far as both of these names are concerned. Now, even last year, just for some context, between the months of April to December, this particular section was allowed, and Tata Power as well as Adani Power had seen a one-time positive impact as far as their EPS or one-time profitability that they had seen. IEX2 benefits on the back of higher demand that is anticipated in the upcoming summer months.
All right, thanks a lot for that. That's on the power space. Let's slip into a quick break. On the other side, it's our special segment, It's the Economy. Lata joins in. She has with her Eric Robertson and Kaushik Rudra of Standard Chartered Bank to discuss the impact of possible rate hikes on the financial markets.